Hi, I'm James Robinson, and this is my stock pick of the week. Today's stock pick of the week is Miller Industries, symbol MLR. We're going to do a five-part series on this video. Each video is going to be about 5 minutes long. We're going to talk an overview about the company, the operations for the company, its debt, its dividend, and its wealth creation. Miller Industries is a really interesting little niche company. I found it when I was doing my research on a company called Martin Transportation, which we bought and sold at a profit. Miller Industries is the world's largest producer of tow trucks and wreckers, so automobile transport or car transport vehicles. The company makes tow trucks with a wide range of capabilities, everything from 4 tons up to 75 tons of lifting capability. So everything from your family car up to a semi can be towed by various vehicles produced by Miller Industries. Their products are used typically to transport distressed vehicles. You've all seen them. They're also used in the automobile industry to transport new and used cars. They do everything from the typical tow truck, which is a hook with a hydraulic on the back, to flatbeds, which you will see will kind of tilt down and allow the car to drive up onto the flatbed, and then that flatbed is hydraulically lifted onto the car. They have operations in all 50 states, plus Canada, Europe, the Middle East, and the Pacific Rim, so they're all over the world. The company has 1,240 employees and is based in Chattanooga, Tennessee. It was founded in 1990, so it's a pretty new company. So in terms of the company's economics, the company has a market cap of $370 million. It has revenues of $795 million, profits of $38.82 million. It has a P/E ratio of 9.45, a dividend yield of 2.15%, and its debt is $22.17 million. So I want to talk about this a little bit. This is an old line manufacturer. So many of the companies that I look at, are software companies or companies that are producing new products that aren't really industrial in nature. And so they're able to generate these fantastic margins. And generally, I really like margins. And I think gross margins is an extremely important component of a company in terms of how I analyze it. So why am I buying a company with gross margins of, call it 5 or 7% or something? The reason is I think this is an industry that's not going anywhere. Right? The world is not going to need less tow trucks 10 years from now than they do today. And they're not going to get easier to make. It takes a factory and it takes a certain amount of people and it takes a certain amount of raw products. You have to, in their case, oftentimes they buy the trucks from somebody and then they modify the trucks to meet their needs. So they have tremendous investment in their products. So this is a company that's going to be around for a long time. You're going to see that its profits have done great over the last 10 years. I'm buying it at a discount to the market. The market's trading at 20 times earnings or something, and we're buying this company at 9.5 times earnings. So even though I'm not getting the margins, I think the margins are safe and secure. I don't think the company's going anywhere, and I'm getting a nice dividend. So I'm buying this company even though it doesn't meet every requirement, because I like the industry. I like the idea of being this niche manufacturer. The other thing that I like about this company is I don't see people clamoring to get into the tow truck manufacturing business. When you've got electric cars, everybody in the world is doing that, and that's fine. And these guys probably will eventually make electric tow trucks. But nobody really wants to take a truck and make it into a tow truck. So these guys are never going to have an awful lot of competitors. And as a result, I think they're in a stable industry, and so I'm willing to overlook some things. So as we discussed, this company, in terms of operating, has some issues that I would not call it a 4-star company. And if it wasn't for its unique niche, I probably wouldn't be interested in it. I mean, its gross margins are inadequate. The net earnings as a percentage of revenue, again, because the gross margins are inadequate. The selling and general administrative is relatively low. Inventory is too high. I'm saying all these things because I want you to know that I've thought about them and I'm willing to overlook them. However, the company has very little debt. Its finances are extremely strong. This is a small company. It's a growing company. It's 25 years old. It's an industrial company. So it doesn't have the ability to throw off tons of money to do things like pay back stock. But I believe that that's coming. I believe that this company is working through those issues, and I think it's going to start buying back stock. I think it's going to pay off its debt, which it has very little, and it's going to increase its dividends. So we'll see if I'm right about that, but that's my opinion. In the meantime, I think the company's doing a good job of growing its revenues, growing its profits, and so I'm interested in the company. So the first question I like to ask about a company is, does it have a consumer monopoly? So a consumer monopoly means the company has place of mind, and people will pay extra for it, like they will Wrigley's Spearmint Gum or Coca-Cola. I'm not sure that you can say it has that. It probably does in its little niche, but obviously for the average person, we don't know about it. What this company does have is, in terms of a competitive advantage, is it's the biggest producer in the world at what it does. And that means that it has economies of scale that its competitors don't have. That means that it does have name recognition its competitors don't have. And so I think that competitive advantage translates to what we would call what Warren Buffett would call a consumer advantage. In the last 7 years, the earnings have steadily grown from 82 cents a share to $2.96 a share, so 3.5 times in 8 years. That's pretty good. The company does a decent job of rewarding its shareholders. It does pay a 2.15% yield, which outperforms the S&P 500, but it doesn't buy back stock, and it hasn't been paying back debt, although it doesn't have much debt. So I would like to see this company do a better job of paying back its shareholders. So the company financially has very little debt. It's very safe. It's an industry that is very stable. I don't see any reduction in the number of cars needing to be towed. And I think automakers are going to need to transport the same number of cars around the country as they have been historically. And that means that our company is going to be in demand for its products. So why am I telling you to buy this company when there are areas where it's not a four-star company? I look at this company as solid in a safe, stable, established industry. I can buy it at a PE ratio of 9.5 or 9.45, and that's compared to the average PE for the S&P 500 of 21.66. So I think this company is on sale. I think this is a value play as opposed to a growth play. So the current stock is trading at $32.18, and so I'd recommend to buy this stock at that price.